Okay, good afternoon and welcome back everyone to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we're here to talk about a very popular trading strategy, one that we use very often in our daily plays, which is selling vertical credit spreads. So we'll talk a little bit about the strategy, just so for those of you that are relatively new to credit spreads, a better understanding as to how they work, when you should utilize them, how do you select the optimal credit spreads. But most importantly, we want to show you how you can find optimal credit spreads using the tools that we have built here at OptionsPlay, and then make sure that you understand how to analyze them and how to manage these if you are trading credit spreads in your account. So let's go ahead and get started. Now, before I do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So for those of you that are brand new to OptionsPlay, if you haven't signed up yet, you can sign up for a free 30-day trial at optionsplay.com so that you can access the tools that we're going to show you here today, both the OptionsPlay platform as well as the credit spread opportunity report that is updated every single hour to give you a better sense for how to find opportunities here in the market. Now, what we have here for today is we're going to be doing maximizing credit spreads, maximizing income with credit spreads this Thursday. Next Thursday, because earnings season is about to kick off again, we're going to start talking about earnings season using options. And then the final Thursday of October, we're going to be doing a live market analysis with Q&A. I am taking the last Thursday off here this week for the month of October. So that's what we have for the month of October. A lot of I would say actionable strategies that we're going to teach you here this month. So make sure that you pay attention to, and then we're going to do a review here at the end of October. Now, we do have a very special election special coming out tomorrow morning. For those of you that join us on each Tuesday and Friday morning market outlook session, we're not doing a regular market outlook session tomorrow morning. We're going to be doing an election special. We're going to talk about what the possible outcomes are for the election, how we're viewing the different industries and sectors that will be affected by the different possible outcomes, by taxes, by regulation, and we'll break down each individual sector and what we're currently looking for. So this is a members only webinar. So you need to either be on a free trial or you need to have a membership to register for that. So I hope to see many of you there tomorrow morning for that at 9 a.m. So today what we're going to do is we're going to talk a little bit about when should you trade credit spreads. It's very important that investors understand when you should utilize credit spreads. They're not useful for all market conditions. They're only useful for certain market conditions. So it's important that you understand when. Then we'll take a look at what credit spreads are, how they're constructed, and more importantly, what are the optimal credit spreads? How do you actually determine whether a credit spread is optimal or not? Then we'll take a look at how to manage your credit spread. So once you're in a credit spread, how do you actually go about deciding when to get out of a credit spread? And then we'll try to do as many live examples as possible using the opportunity reports that we're going to show you here that's available to you for everyone here at OptionsPlay. And at the very end, we'll open this up for Q&A. So the primary objective that I want to help investors walk away from today's webinar, which is really understanding how can you find and trade the most optimal credit spreads. And when I refer to optimal, I'll show you here in a few minutes as to what we mean by optimal and how can you quickly find them so that you're not searching manually through symbols and options chains to figure out what symbols to sell credit spreads on, how to find expiration dates and strike prices. Our opportunity reports automate all of that work for you. So we want to show you how to access them and, more importantly, how to use them, analyze them, and trade them. So my name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And what I'm going to do here today is show you the tools that we have developed here at OptionsPlay that's designed to help you find these strategies as quickly as possible, analyze them so that you know what are optimal ones, what you're seeking when you're selling a credit spread for you to go ahead and execute those in your portfolio. So let's first talk a little bit about when should you sell credit spreads. Now, the thing about credit spreads is that they're only useful in certain market conditions. First of all, many investors, especially for those of you that are experienced, I tend to get a lot of answers from experienced options traders that will tell me that it's best to sell credit spreads in a higher volatility environment. And that is absolutely true, that generally speaking, in a higher volatility environment, credit spreads will do better. But it's important to understand that just because you have a high volatility environment does not mean that other strategies are not suitable. Many times you can still use other strategies even in a high volatility environment. So what I want to be more clear on is respect to the directional view, because even though you have relatively larger exposure to implied volatility when volatility is high, so when you're selling credit spreads in a high volatility environment, you're going to get a little bit more profits. You're going to get a little bit more profit from the fact that volatility is likely going to mean revert and give you a little bit of boost to your profits. However, even with credit spreads, your biggest exposure is not to Vega, which is implied volatility. Your biggest exposure is still to delta. So the directional view that you have on an underlying stock is still going to be the most important aspect to determine when it's optimal to sell a credit spread and when you should actually sell that credit spread from a directional perspective. So when we look at credit spreads, we generally want to do them around reversal points. So whenever we think that markets are going to reverse from one direction to the other, these are your optimal conditions to sell a credit spread. You want to do them during market reversal. So this could be many different ways to do that. You can use support or resistance. That's the simplest way to look at a chart and see where you think a market may start to reverse either higher or lower. For other technical analysts that use different type of momentum indicators, whether you use RSI or MACD or stochastics, anytime when an oscillator is either overbought or oversold are also conditions for potentially selling a credit spread, because again, overbought and oversold conditions tell you that momentum is shifting and it's turning around and reversing in the opposite direction. And lastly, when you have a trading range, when you've established a trading range and you think that the markets are going to stay within a specific range, that also is, generally speaking, a good opportunity to sell credit spreads. So the first thing to remember with credit spreads is the fact that your biggest exposure is still to delta, not Vega. So don't use implied volatility as your sole decision-making process as to whether you want to trade a debit or a credit spread. We're going to explore a little bit about the difference between debit versus credit spreads after we explain credit spreads. But the first thing to remember is the fact that directional view is still the most important thing when you're selling credit spreads. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Delta is still always going to be your largest exposure, even when you're selling credit spreads. So don't just use implied volatility as your sole decision-making process as to whether you want to trade a debit or credit spread. Make sure that you have a good sense for the directional view and use these types of technical indicators to determine when prices are about to reverse, because that is going to be your optimal time to sell a credit spread. So for this, what I'm going to do is I'm going to walk you through 2 types of credit spreads, because there's a bullish credit spread and a bearish credit spread. We're going to talk about the bullish credit spread first. This is when we have a bullish to neutral view. And I'm using IBB here. This is an older chart here of IBB when it's clearly in a strong uptrend. And what I particularly looked for was small reversals during this uptrend that signified a potential reversal, because every time it declined a little bit towards that 20-day moving average, that became the subsequent reversal higher. So this is an opportunity to potentially see that IBB in a clear uptrend pulled back for a few days to the 20-day moving average. Here's my opportunity to look for a reversal in that trend to resume that longer term bullish trend. So this is an opportunity where you could potentially sell a credit spread. So in this particular case, IBB was trading at just around 142 or so. So the optimal credit spread is to generally sell a put near the current price of the stock, because that maximizes the income that you collect, because at the money options will always have the most amount of extrinsic value, and you're maximizing that by selling the at the money put option. However, when you sell an at the money put option, you are taking on, number one, a substantial amount of risk if the stock is to substantially reverse lower, and number two, when you sell a at the money put option, you're going to have to put up a lot of cash or margin in order to sell that short put. So most investors don't feel comfortable enough to sell that naked call or cash secured put. Naked put or cash secured put, because maybe they're concerned that there is maybe a small but inherent possibility that that the IBB or this ETF declined significantly. I would say the number one question that I get from investors saying when we talk about selling cash secured puts on stocks that we want to own is, what do I do if the stock declines substantially? The answer is there's not much you can do. The same thing, there's not much you can do when you buy a stock and the stock declines substantially. That's the risk that you're taking when you buy the stock. That's a risk that you're taking when you sell a put option. But not every investor wants to take on that risk. So that's why we turn to credit spreads. Credit spreads allow us to take a very similar trade to selling a cash secured put or a naked put at the money, which maximizes our income, but we do it in a way with limited risk. So what we do is we buy a lower put against it. In this particular case, let's say I buy a 136 put against it. And let's say I collect $5.10 by selling the 142 put. I pay $2.95 to buy that 136 put. Now what happens is, instead of risking roughly $142 or so, or rather $137 or so to make $5. Here, what I'm doing now is, by buying that lower put, I've reduced my potential reward, right? I've reduced it from $5.10 down to my net credit. My $5.10 down to $2.25. But what I've done is I've decreased my risk. So if I just sold the naked put for about $5, then my total risk on that trade is about $137. Granted, that's far-fetched because the stock would have to go to zero in order for that to happen by my expiration date. But what I have done is I've reduced my risk from 137 down to just $3.75. So this allows you to potentially sleep at night and know that no matter what happens, even if the world turns around while you sleep, you're not taking on substantial amounts of risk. You're not putting on a huge amount of risk in your portfolio. And you can, normally to sell a single put, you would have to put up roughly $137,000 in cash to sell, $13,000 in cash to sell this naked put. That's a substantial amount of money, versus to sell the credit spread, you only need $375. So that's really, in my opinion, the real reason why many investors would rather sell the credit spread rather than sell the naked put, because the naked put simply requires too much in terms of cash to be set aside to make that $5, versus if you can set aside just $375 and make potentially $225, that makes a little bit more sense, okay? Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. I'm not sure. Someone said that I did my math wrong here. If this is 215, and that the risk is actually 385. Okay, I apologize for that. A bit of a math error on my end. So let's see, 510 minus 95. That's correct. So a little bit less credit than we were looking for, 10 cents less credit. But the thing that we want to think about whenever we're talking about a credit spread or any type of vertical spread is really the distance between the two strike prices. The distance between the two strike prices tells us how much money is at play. Whatever the distance is, that's the maximum amount that we're in play on any type of vertical spread. So a 142, 136 is a $6 wide credit spread, the distance between the two strikes. So whenever we talk about the width of a vertical, we're talking about the distance between the two strikes. And what we generally want to take a look at is how much credit are we receiving as a percentage of that width? Because whatever your width is, the collection that you have in terms of income, the rest of it will be your risk. So whatever you collect in income, the rest of it will be your risk. So whenever you're able to maximize your income, what you're doing is you're reducing the amount of risk. The more you take in an income, the less risk that you're actually taking. So this was calculated off of the 225, which we know is off by 10 cents. But 225 out of a $6 wide credit spread means that I'm collecting 37.5% of the vertical width. That means the rest that I'm risking is going to be my potential risk. So here I'm risking 37.5% of the vertical width, or my potential reward is 37.5% of the vertical width, and my risk here is 62% of the vertical width. So what I'm trying to do is always to find credit spreads that maximize the amount of income, because that for every dollar that or every cent that I increase my income by, I decrease my risk by that 1 penny. So the goal here is to always make sure that you try to trade strategies that give you the highest amount of income. The highest amount of income also gives you the largest buffer. So in the past month, in September, we learned about buying versus selling options. And we learned about a few different scenarios that when you're buying options, you need the stock to make a big move in order for you to be profitable. When you're selling options, you have a lot of different ways to make money. If the trade goes in your favor, you make money. If the stock stays put, you make money. Even if the stock goes a little bit against you, you also make money. And only if the stock makes a big move against you do you lose money. So when you're selling a credit spread, you have the same risk profile. Meaning, if IBB starts to move higher, I'll make money on this trade. If IBB moves sideways and doesn't move higher at all, I make money here. If the IBB goes a little bit lower, I still make money. The only time I lose money is if IBB takes a big plunge to the downside. As long as IBB stays above 139.75, which we know is actually 139.85 because of the 10-cent error that I had, as long as IBB stays above 139.75, I'll be profitable on this trade. So that is what attracts many investors to selling credit spreads. It's a high probability, it's a very forgiving strategy. If you get the direction right, you make money. If you get the direction wrong, you can still make a little bit of money. Only if you get the direction completely wrong do you really lose substantial amounts of capital. And that's what many investors are seeking when they're trading these types of credit spreads. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Okay, so let's just take a look at a bearish example here. Now, let's just say you have a contrarian view on IBB. You believe that IBB is near a top. You think it's going to start reversing lower for whatever reason, and you think that it's now going to start perhaps reversing a little bit lower. So as an options trader, what you can do is naturally, as a first step, you might want to sell a 142 call option. So in this particular case, if I sold this 142 call option for about $4.80, this gives me a little bit of a buffer, meaning as long as the stock stays where it is or moves even a little bit higher, I'm able to be profitable. And if the stock does move lower, I'm going to collect my $4.80. But the problem with selling a naked call is that you truly have unlimited risk. If IBB continues to move higher, the higher it goes, the more money you lose. And the only thing you have to show for that risk is just $4.80. Not a whole lot of potential reward for what could potentially be a lot of risk. And this is why many investors who don't like to sell naked calls or puts, not to mention selling that naked call is going to require a fair amount of margin in order to do so. So what you can do is you can buy back a higher call. Let's say you buy the 148 call and spend $2.25 to buy it. Now, instead of bringing in a net credit of $4.80, now you're bringing a net credit of just $2.55. But in order to do that, what you've done is you reduce your risk on the entire trade down to just $3.45. Now, in this example, just like before, we're trading a vertical spread that is a 142, 148, which, as we said before, the distance between the two strikes is the maximum amount of capital that's at play. So that's $600 per contract. So when you have a vertical width of $6 and you're collecting $2.55, before in the previous example, in that bullish example, $2.15 was about 36% of the vertical width. Here, we're collecting $2.55. We're really getting a little bit more income for it. And what that equates to is now a vertical width of 42%. Before we were collecting 36, 37%. Now we're collecting 42%. And this is really where it starts to get interesting, because when you're able to collect 42%, that means instead of you're only risking 58% of the vertical width in order to to take on this type of reward. So now your risk to reward, like before, was closer to 2 to 1. This one is much closer to 1 to 1. So you're looking at 42 to 58. Before, you were looking at about 37 to about 60, 63 or so. So this is really where when you're able to maximize your income, what you're able to do is reduce your risk. And this is really the goal of what we're trying to seek. When we refer to optimal credit spreads, we're really trying to seek credit spreads that give you the maximum amount of income possible so that we can minimize your risk, so that all things are equal, you're able to be profitable more often because you have a bigger buffer. Because now that you have a $2.55 credit, your buffer is also expanded from about $2.15 in the previous example now to $2.55. So even if IBB moves higher, you now have a larger buffer before you lose money on this trade than before, because you've increased your income by that extra 30, 40 cents on this particular trade. So if IBB stays sideways, you make money. If IBB moves lower, you make money. And if IBB moves a little bit higher, you'll still make money. The only time you lose money is if IBB makes a big move to the upside. Does that make sense? Please type 4 into the chat window if that makes sense to you. And I know there's a few questions, and I will get back to you on some of these questions, but I do want to get through this content, and then I will come back for questions here at the very end. So just to recap, the credit spreads, they are what we call a very forgiving directional strategy, because you could really get the direction wrong and still potentially make a little bit of money. But it's really suitable for when you expect more of a neutral or small directional move. The reason that it's not suitable for when you expect a big move is that there are far better strategies for it. That's what we learned last month in our buying versus selling options webinar. I highly recommend, if you missed that, to please go back and watch that, because what we learned from that webinar was the fact that when you do expect a big move, you're much better off buying a call or buying a put or buying a debit spread, which is something that we will talk about here in the next month or so. Buying debit spreads are very useful when you expect a big move in a specific directional view. Now, credit spreads do generally work better in a higher implied volatility environment. Now, how do you measure a stock with high implied volatility? That's really where we turn to IV rank. We're going to show you how we measure IV rank on our credit spread opportunity report so that you know which ones have higher IV rank. But generally speaking, any IV rank above 30 is considered relatively high, and anything above 50 is considered extremely high. So if you see an IV rank above 50, that has a much higher probability of giving you better returns than IV ranks below 30. Now, from a directional perspective, like I said, even though it is a strategy that gives you better returns in a high implied volatility environment, you still need to get the direction right. So you generally want to look for extreme overbought or oversold conditions using technical indicators. You want to look for reversal points, whether you're looking at top and bottom formations using chart formations, or if you're looking at support or resistance levels. These are all suitable ways to determine a potential reversal point at which you may want to sell a credit spread. And lastly, you do not want to use this strategy when you're expecting a large and fast move. So you only want to use this when you expect more of a small and neutral move in the broader markets or in the specific name or ETF that you're currently trading. So with that, what I want to do is help investors better understand the trade-off that you're making when you're selling credit spreads. Because many times investors will say, well, I will obviously choose the strategy with a higher probability. I will obviously choose the strategy that makes me money in 3 different scenarios rather than just requiring the stock to make a big move. But what's important to understand is that you are making a trade-off when you select these higher probability trades that make money in a lot of different scenarios. And it really comes down to the fact that whenever you're choosing any option strategy, doesn't matter if you're trying to select different strike prices, different strategies, you're always making a trade-off between 2 important factors, and that's risk to reward and probability. So a lot of investors, if we talk about just buying call options, you can buy at the money call options that are relatively expensive, or you can buy these really far out of the money call options that are really cheap. And unfortunately, I see too many beginners will say, well, I'm going to buy the cheap one because why would anyone want to buy the expensive one? Not really realizing what trade-off you're making when you're buying these really cheap out of the money options. And it really comes down to the trade-off between probability and risk to reward. A lot of investors tend to get attracted to the cheap, really high risk to reward strategies, meaning if you buy these really far out of the money call options, which fueled some of the rallies that we saw in late August, these out of the money call options that made a boatload of money in a very short amount of time. And guess what? That stopped working immediately right after it did work for about a month or two. And it really comes down to the fact that that's a trade-off that you're making. When you seek these really high payoffs, those really high risk reward ratios, you have very low probability in the long run of making money. And that's the same thing that you have when you're selling credit spreads. Credit spreads have higher probability of profit, but it's important to remember that you have substantially worse risk to reward ratios. Most credit spreads, you're risking usually at least double of the potential reward that you can make, but you do have more winners. So you win more often, but the times that you will lose more than what you win each time that you win. Subsequently, when you buy options, when you're using debit spreads, what you have are really low probability of profits. A lot of investors will say, well, something has 33% probability of profit. I'm not interested in that, because they're thinking to themselves, well, if I lose 2 out of 3 trades, I'm never going to make money. But what they don't realize is the trade-off with that. With the trade-off of low probability is that you have better risk to reward. For most debit spreads, you're risking $100 to try to make $200. So your risk to reward are at polar opposites, if you will, and probability. And what you're trying to do is find a balance. Or within each strategy, what you're trying to do is you're trying to maximize or give yourself an edge. So what we're trying to do is move this from, instead of $200 worth of risk for every $100 in reward, what we're trying to do is something along the lines of, how do we reduce your risk here to about 180 and increase your reward here to about 120 or so, something along these lines, because whenever I'm able to increase my reward, what that does is it decreases my risk. And we do the same thing when we're trading debit spreads. We try to reduce our risk as much as possible, because what that does is it increases our potential reward. So one strategy is not better than the other. I keep hearing from investors saying, I prefer to sell credit spreads because they're better, or I prefer to do this because they're better. The reality is that none of these are better than the other. They're all similar, because you're just making trade-offs between probability and risk to reward. Is low probability worse than high probability? No. Is high probability better than low probability? No, not at all. You just have to understand what you're trading off for that probability. And that, I think, is one of the most important lessons to learn when you're trading options, because everyone's seeking this kind of holy grail or magic bullet that somehow makes them more money. And the reality is that that doesn't exist. But once you understand these concepts, you can make better decisions that can put the edge in your favor. And that's what we're going to show you here today. So if that makes sense to you, please type 5 into the chat window. Perfect. So now that we've given you a few examples, let's talk a little bit about what are the optimal credit spreads. So from our perspective, and this is something that, for those of you that join the sessions with Tom Sosnoff at Tastyworks, we've talked about this a lot, and we have slightly differing views as to what are optimal credit spreads, but we all agree that the different choices that you have with respect to credit spreads, generally speaking, the difference in terms of performance between each one is generally relatively low. So what we feel are the optimal credit spreads based on our back testing is really designed to minimize risk as much as possible. Our goal whenever we optimize for credit spreads is to minimize risk, because when we minimize risk, we're able to maximize our potential returns, even if that means that you have a slightly lower probability of profit. But the part that Tom and I generally agree on is that you generally want to sell about 45 days out from expiration. You want to start out about 45 days out. Where we disagree a little bit as far as which legs you buy and which legs you sell. We sell the 50 delta and we buy back the 25 delta, which makes your net delta about 25 delta. So your net delta here is about 25 delta. Now what Tom likes to do is he likes to sell the 35 and then he buys the 20, so that his net delta here is only about 15. Now, what his strategy does is that, generally speaking, his strategy will have higher probability of profits, but lower income. Our strategies will have slightly lower probability of profit, but higher income. Now, this is really where you as an investor could make decisions on your own. And we're going to show you how you can use the OptionsPlay tool to do that. But we are also going to show you the tools that will first point you in the right direction, and then you can make the choice for yourself as to which strategy is best suited for you. But we both agree that generally speaking, you want to try to collect at least 1/3 of the distance between the two strikes. So if you have a $5 wide credit spread, you want to collect about $1.67, $10, $3.33, $20, $6.67. So generally speaking, these are probably the most common credit spreads that you'll sell. So we generally have kind of these burned into our head whenever we're selling credit spreads, is that regardless of what width you're looking for, you generally have a range as to what you're trying to seek. Now, when you're using these types of strategies, you'll usually see that you'll have about 67% winners, or 67% probability of profit, while risking about $200 for every $100 in potential income that you receive. So that is what we generally consider the optimal credit spread. Now, I consider this optimal because I never want to risk more than 2 times what my potential income is. And when we sell the 50 to 25 delta, what we generally tend to find is that we can actually get many times closer to 40% of the width rather than 1/3. So when we have 40% income, what that means is that our risk is reduced to 60% of the vertical width. So instead of risking 2 to 1, we're only risking about 1 to 1.5 or so, which significantly reduces our risk. And that's what we're trying to seek in our strategy reports that I'll show you here in 1 second. But before we move on to showing you our opportunity report, I do want to talk a little bit about, once you've entered a credit spread, how do you go about managing it? And generally speaking, this is the part where Tom and I are in complete agreement on, which is really that there are 3 possible triggers to exit your credit spread. And whichever one triggers first, that is your signal to get out of the credit spread. Whether it's at a profit or a loss, you want to get out whichever one of these 3 triggers first. So number 1, if you get to 21 days to expiration, that's the first trigger. The second trigger is if you've made 50% of the max gain. And the third trigger is you've lost 100% of the max gain. So just to give you an example, if I sell a $5 wide credit spread, and let's say I collect $2 in income for that $5 wide credit spread, what I want to do is, if I reach a $1 profit on that particular trade, I would take profit. If I reached a $2 loss, I would take my stop loss. Or if I reach 21 days to expiration first without reaching either take profit or stop loss, I would also get out of the trade. Regardless of whether I'm in a profit or a loss, if I'm at 21 days and I haven't reached my take profit, or if I haven't reached my stop loss, I would simply get out of the trade. So I just want to make sure everyone understands the math here. So I sold it originally for $2. So if the trade starts to go in my favor, then the income that starts to decline, so half of the max gain. So my max gain here is $2. Half of that is $1. So if it goes from $2 down to $1, then I've gained $1 on the trade. So then I would take my profits and move on to the next trade. If this trade starts to go against me and the value of the credit spread starts to rise instead of decline, and it rises up to $4, that's when I would consider cutting my losses and taking a loss on that particular trade. And if, let's say, it reaches 21 days to expiration and we are not at either one of these profit levels, either take profit or stop loss, then I would get out of the trade altogether. Now, some people will ask about rolling, whether it makes sense to roll. From my perspective, if a trade is going against me, it doesn't make sense for me to roll, simply because the directional view that I had on the trade is incorrect, and I'm not going to continue rolling and putting more money at risk for a trade that just didn't work out. But if the trade starts to go in my favor, maybe it hasn't reached my take profit yet, but it did reach 21 days to expiration, that is an opportunity to roll your position out another month and maybe adjust the strike prices a little and stay in that trade. So for example, if IBB continues to grind its way higher, but it doesn't move much higher, but at 21 days to expiration, maybe I've made 20 or 30% of the max gain, then at that point, I may ask myself, do I think IBB is going to continue moving moving higher. If I do, then I may roll that trade into from a November, maybe out to December. But that's really the time where I would want to roll my position. When a trade goes against me, that's not when I want to roll my position because I simply got the direction wrong. I don't want to throw more money at a trade that didn't go correctly. You can place another trade if you feel strongly about it, but generally speaking, that's not what I do. But that's a choice that you have to make. I'm just letting you know what I generally do when it comes to deciding whether it makes sense to roll. Does that make sense, everyone? Please type 6 into the chat window if that makes sense to you. And I know there's a lot of questions here. I will try to make sure that I get to your questions. A lot of questions about the 21-day rule. The 21-day rule really comes down to the fact that many investors have this view that time decay is fastest in that last 2 to 3 weeks. But what they don't realize is that when you have very fast time decay, there's an additional risk that you're taking on, which is gamma risk. And gamma risk starts to outweigh the acceleration in time decay in those final 2 to 3 weeks, which is why whenever we're selling options, selling credit spreads, selling covered calls, selling naked puts, selling iron condors, we generally want to avoid holding those trades in the last 2 weeks because in those last 2 weeks, yes, you're getting a little bit extra income per day, but you're taking on a whole lot more of gamma risk. And what we're trying to do is avoid that gamma risk. That's why we close it out 21 days from expiration. If we want to roll it out another 2 months out to the December or January, or however long you're going out, you can do that if you want more time on your trade, but always roll it out. Don't hold it in the last 2 to 3 weeks into expiration because you're taking on a lot more gamma risk. So, with that, what I want to show you is the credit spread opportunity report that is available to all OptionsPlay members. You can find the credit spread opportunity report at the bottom of your OptionsPlay platform when you click on the credit spread report or credit spread link. And what it'll take you to is an opportunity report. And I'll show you very quickly as to how the opportunity report works. But what the opportunity report is designed to do is that there are 4,200 symbols that you can trade options on. But we know that the vast majority of those 4,200 is not very liquid. So first of all, we filter out all of those non-liquid symbols. So we're only looking at what we consider very liquid optionable symbols. This usually is about 100 to 200 names per day. And then what we're looking for are credit spreads that collect the minimum of that 33% that we're referring to. Because if we collect less than 33%, that means we're risking more than 2 to 1. So we never want to sell credit spreads where we're risking more than 2 to 1. So by filtering out 95% of the names through liquidity, and then we take a look at all the spreads, all the credit spreads that don't collect at least 33% of the width, meaning the risk rewards are not in our favor. And then lastly, what we do is we align it with our technical view. So what we have is a directional edge on the view of the trade. Like I said, one of the most important things of selling a credit spread is still the directional view. So what we have is a report that gives you out of the thousands of possible combinations, and thousands is it's really more like millions of possible combinations. It filters it down to usually in the realm of 10 to 20 possible credit spreads. And this report is actually updated for you every single hour. And to understand how to read this report, you can read it from left to right. First of all, you have symbol and direction. That is pretty straightforward. What symbol is it? Is it a bullish or bearish trade? Then we'll tell you the credit spread details, meaning what strike price are you buying? What strike price are you selling? What expiration date are we using? And then one of the most important things is risk to reward. This is what we're talking about. How much are you collecting of the vertical width as a collection of the income? The higher on the list you go, the better the risk to reward. The lower you go on the list, the worse the risk to reward. So what you always want to do is focus on the ones at the top of the list first, because those are the credit spreads that give you the maximum amount of income for the amount of risk that you're taking. So this APA trade that I'm talking about here collects $1 out of a $2.50 wide credit spread. That's 40% of the width. That means I'm making potentially 40% of the width and I'm risking only 60% of the width. This is when the risk to reward is skewed in my favor. And then we have a few different things that helps you better sort and filter these if you'd like, which is IV rank. We talked about IV rank. When high is, generally speaking, a better opportunity for selling credit spreads, and also the next earnings date, so that you know whether or not there's an earnings coming up. Generally speaking, we don't love selling credit spreads going into an earnings event. So we generally want to understand if there are earnings coming up. Now, with earnings season coming up right now, it's a little harder to avoid. So maybe sometimes you could sell a 45-day option on something that doesn't report earnings for another 20 or 30 days. That's fine, because you're likely going to exit the trade before that earnings date, but it's important that you know what the IV rank and the earnings dates are. And like I said, this report is updated hourly. So the very last column tells you when the report was last updated. We update this every single hour, starting at about 10:15 a.m. after the market opens. We update that every single hour all the way through the close. And the last snapshot is around 4:15, 4:16 or so after the close. So we generally use this report intraday. We generally don't use it after hours. And the reason only because of that is because after hours, we tend to see that the spreads get wider. So sometimes we get some funky premiums that are not really executable. So that's why, generally speaking, we use this report only during the intraday. So this is a report that you all have access to, and it really allows you to quickly scan for possible opportunities. And I'll show you this real quick using the current credit spreads report. So this is what was generated just about an hour ago before we started this this webinar. So the two that kind of jumps out at me are the two Tesla and SLV. Now, Tesla reports earnings in 13 days, so that may not be the best suitable one, but it does have a relatively high IV rank. So for those of you that perhaps are looking for an earnings play, this is also one way that you can play earnings with limited risk. But the one that I wanted to take a look at was silver. Silver collects, in this particular case, 39% of the width. It's got an IV rank of 40%, which is pretty high here. And silver is currently trading at 22.20. This would sell the 22 strike, buy back the 20s. That's a $2 wide credit spread that I'm collecting 77 cents on. That's 39% of the width. So what I would do is I would take this trade, I would bring it up in OptionsPlay, and I would look at this using OptionsPlay. So SLV, and I was looking at gold here earlier today, or silver, certainly broke down below that support level, but recently finding a little bit of support. Maybe it's ready to bounce back higher here. So this depends on whether you agree from a directional perspective, but silver looks a bit oversold. Those are the conditions that we generally look for a bullish credit spread. And what we were looking for is to sell the 22 and buy back the 20 put credit spread. As you can see, the midpoint here is still 77 cents. So I'm still able to execute this trade at the price from about a couple of hours ago. And this allows me to utilize the OptionsPlay tool to see what happens and how much premium do I potentially collect if SLV starts to move higher between now and expiration. So if it moves up to, let's say, 23, how much can I potentially make by, let's say, Halloween? So using the P&L simulator allows me to better understand what my potential outcome for these credit spreads are. But this means that I don't have to search for specific symbols. I don't have to see if there's liquid or not. I don't have to specifically pick expiration dates and strike prices. The report does all of that work for you and provides you all the information that you need to decide very quickly which one of these you want to pay attention to, plug it into OptionsPlay, and immediately be able to analyze them and potentially trade them or execute them into your broker's platform. So I'll just take a look at a few of them here just to show you how quickly I can take a look at this. Let's say I don't mind Tesla's earnings coming up in 13 days. And I see that Tesla's trading at 429 or so. This is telling me to sell the 420, 356 put credit spread here on Tesla. So let's take a look at that, 420, 356. So Tesla's certainly been range bound here for the past couple of weeks or so. It's been trading itself into a bit of a triangle here. Maybe you think that there's going to be a breakout here to the upside. So what we can use is we can use our strategy constructor to construct a short put vertical. We're going to sell the 420 by the 356 or so. So that is a $50, $60, $64 wide credit spread that I'm collecting $26.60 for. $26.60 on a $64 wide credit spread is a little over 41% of the width here. So this is one, well, I mean, Tesla does have very high implied volatility. You know, as we saw here before, the IV rank here is 39%. So that's why I'm able to collect a little bit more premium here. Collecting that much premium allows me to, again, minimize my risk. And you can use this tool to help you understand what's your maximum reward, what's your maximum risk, and quickly be able to calculate that using the OptionsPlay tool. So this is really designed from the ground up to make your credit spread trading experience as quick as possible, because I know that as a trader, the amount of time it takes you to, number one, research an underlying stock, pull up the option chain, determine which expiration date, strike price, liquidity, IV rank, earnings date, all of that stuff takes a lot of time to collate that data. And many times you do all that work and then you realize that the credit spread doesn't collect enough premium, or there's an earnings coming up, or the IV rank's not high enough. There's a lot of wasted time in that. We wanted to avoid all of that through this credit spread report. And this is designed from the ground up to facilitate us as traders to quickly find these opportunities. And we many times use this to find our daily play ideas. We pull from these reports to look at these stocks, to see opportunities, and these are the ones that we present on the daily play ideas. So this is a very powerful tool for those of you that are looking to sell credit spreads, to find ideas, but also be able to understand how they're constructed. So I hope that this webinar was helpful in giving you a better understanding of credit spreads themselves, and more importantly, the tools that we have here at OptionsPlay to help you find and hopefully execute and analyze these types of trades. So with that, that covers what I wanted to share with you here today. I hope that this was, again, helpful for those of you that are relatively new to credit spreads to learn more about it. And for those of you that are currently selling credit spreads, I hope that these tools will help you quickly find opportunities in the market rather than taking so much time to find those. So with that, what I'll do is I'll open this up for Q&A. I have a few minutes available for Q&A. I don't have a lot of time. However, there's a chat window and there's a Q&A window. What I'd like, please, is if you have questions, to please type them into the Q&A window. And I will answer your questions through that Q&A windows section. And I will do it as quickly as possible, but I do have to run here in a few minutes, but I do want to try to answer as many questions as possible. Michael's asking, what do the colors indicate? So the colors are really color coded so that, I think from a premium width perspective, it's fairly self-explanatory. The green ones means that you have the most amount of income for the amount of risk. From an IV rank perspective, what you're looking for are red IV ranks, because the higher the IV rank, the redder they are, if you will. The lower the IV rank, the greener they are. So it's just color coding, so it's easier to spot which ones have a higher IV rank. So Facebook, as you can see, out of all of these, actually have the highest IV rank here out of all of them. But this particular one only collects 34% of the width. So the premium here is not as attractive as something as this, but certainly still up there in terms of an opportunity that is suitable, in my opinion. Define IV rank. IV rank is just taking the, let's say this was the implied volatility chart of a stock over the past year. All we're doing is taking the absolute low, right? So let's say if this was 10, and we're taking the absolute high, let's say this was 100, then what we're going to say is, where is today's value in respect to this range? So like we said, the range was from 100 to 10. So if today is down here, then what we're going to say is IV rank is maybe 10%, meaning it's at the bottom of its 1 year range. That's what IV rank is trying to tell you. But if let's say IV was up here, it would tell you the IV rank is 90, meaning it's very high compared to the range that it's been over the last year. So that's how IV rank is calculated. It's pretty simple. When I log into OptionsPlay, I cannot find it. Bill, you can't find the credit spread report. It's at the very bottom of your screen on the black bar, the very bottom, called credit spreads. Is there a separate subscription to the credit spread screen, or is it part of the package? It's part of your OptionsPlay membership. Is IV as high day prior to earnings? What is the best play? If IV is high day prior to earnings, what is the best play? So David, like I said, IV is not your sole decision-making process as far as what's the best play. The best play is dependent on your directional view because your biggest exposure is the delta. So if you think the stock's going to make a big move, perhaps you might want to look at buying some calls or puts or spreads. If you think the stock's not going to make a big move, then you definitely want to sell credit spreads like this. But it depends on where you think the stock's going to go. Lawrence is saying, have you ever dealt with an early assignment? Is it a risk that you need to be concerned with? That's a great question, Lawrence. Yes, early assignment is not particularly the most fun thing to go through, but keep in mind that when you get assigned early on a credit spread, it doesn't change the risk of the trade. Your maximum risk remains the same, even if you get assigned early, unless you let the short leg expire and you still keep the stock leg. That's when your exposure changes. But as long as you hold the trade to expiration, your risk does not change. So generally speaking, if you get assigned early on a credit spread, the best thing to do is to simply close out both legs, the stock leg and the remaining long put or call that you have left, and get out of the trade altogether. It's not a high risk, but if it does happen, you generally just want to exit the trade. Can you please explain gamma risk? So gamma risk is really the risk that you take being short the option. So delta goes from 0 to 1. That's your delta range. And at expiration, as you get closer to closer expiration, the stock becomes very sensitive. It can either go all the way to 0 or all the way to 1 very, very quickly, even with a very small change in the underlying stock price. So gamma tells you how fast the delta is changing. So as you get closer to expiration, the at-the-money options have the highest amount of delta risk, meaning you can go from a big winner to a big loser in a very short amount of time based on just the stock price moving a very small amount. So it's the sensitivity to P&L from the stock price moving up or down. And gamma gets really high as you get closer to expiration. And that acceleration in gamma risk is not worth it in the last 2 weeks before expiration. Why does the credit spreads not score over 100? It really comes down to the risk to reward ratio from the fact that you do still have a fair amount of potential risk here. Now, Tesla is a volatile stock. So even though we're buying back to 356, notice that the trading range for Tesla is all the way down to 307. So there's a still high amount of probability that Tesla will actually move down substantially. So that's why the OptionsPlay score is not particularly high, because you still have a fair amount of risk that Tesla blows through your lower strike and continues moving lower between now and the November expiration. But again, we're not really trading till November expiration, to be perfectly honest. We're really trading closer to October 30th. As you can see, that's closer to 338 as the expected trading range. So you can use that to kind of adjust your expectations for your outlook for the underlying stock. What about DRM? I'm not sure what DRM refers to, Chuck, if you can clarify. Please explain buying versus selling delta. So if you're long an option, you're long delta. If you're short an option, you're short delta. Sorry, I take that back. A long call is long delta, a short call is short delta, a long put is short delta, a short put is a long delta. It really depends on, it's just your exposure to the underlying stock. Delta is just telling you whether if you make money if the stock goes higher or lower. So that's all delta is telling you, is the sensitivity of your option to the underlying stock price moving higher or lower. What's your favorite technical indicator when deciding to sell a credit spread? I tend to use either a CCI, Commodity Channel Index, or an RSI. Those are probably my two favorite indicators. I am doing a special members only webinar next Friday. So this Friday, we have an election special. Next Friday, I'm doing a technical analysis one. I'm going to be talking about indicators. We've back tested thousands of indicators over 13 years, and we have the performance reports of all these technical indicators. I'll be sharing that with you in our members only webinar next Friday. I hope those of you that are interested in technical analysis will be able to join me for that. Jacob saying, should credit spreads be bought at market or limit prices? If limit, what limit? You should always use a limit price, and we always encourage you to try to start with the mid price and move your way up, or move your way down, sorry. And we actually have a webinar just on this alone, entering option orders, on our YouTube page. I highly recommend you to watch that, Jacob, if you have not watched it. James, can we get these slides? Yes, all the slides are available to you in the YouTube description. Every single time we upload something to YouTube, the slides are linked in the description. So please, if you're watching any of our webinars on YouTube and you want the slides, look in the description. You'll be able to download the slides. Is there a subscription to access OptionsPlay spreadsheet? So the full OptionsPlay membership gives you access to all of these things, the earnings calendar, the liquidity report, the credit spread report. That is all included in your membership for OptionsPlay. There's no additional subscription for that. Would still like to know about P&L data. I'm not sure what you mean by Clifford, what you mean by P&L data. If you don't mind clarifying, I'm happy to answer that question. Where can you find the spreadsheet? It is at the bottom of your screen here where it says credit spreads. That's how you can find the spreadsheet. Could you, I think I've just talked about that. Could you explain what you mean by gamma risk? I think I've also discussed that as well. What is the math of the 3,700 and 1,1700 original credit spread? Oh, Jacques, I was saying that if you sold a naked put, not a credit spread, I was saying that if you sold the naked put here, if you sold this 142 put, you would subtract $5 from 142. That gives you roughly $137. Multiply that by 100 shares. That's how you get a margin requirement of about $13,000 to sell a naked, to sell a 142 put, a cash secured put on that IBB. That's what I was referring to. Are they updated on the hour every day? They're updated about on the 15 on every hour. So 10:15, 11:15, 12:15, and so on, all the way through 4:15. What is an easy way to tell my profit is at 50%? So Edward, that depends on your brokerage firm. Each brokerage firm has different ways to show you your P&L. Most brokerage firms can display your P&L from a percentage perspective. That would be the best way. What's the risk reward for condors? Deltas, so we usually sell about a 35 delta on an iron condor and buy back about a 20 delta on an iron condor. So those are the deltas that Tom refers to in his credit spreads. Ted is saying, received today to close CRM call spread, but did not change in the web. So Ted, we will update that after the close here today. Philip is saying, hey, Tony, so when we sell a credit spread, it is not considered a naked call. No, it is not a naked call because it is covered. It's effectively covered by the long call that you've purchased. R. Michael Donovan, another great educational session. OptionsPlay is a great tool for someone trading options. Any option strategy works well for me. Thank you so much. I really appreciate those kind words. Brad, suggestion, consider inverting the color coding for IV rank so that you're looking for green across the board for the best ideas. Okay, Brad, I can take a look at that. I mean, we usually want to use high IV with red. We usually associate that color red with high IV and green with low IV, but I'll take a look at that. Bill is saying, I don't have the black bar. Bill, send me an email at info@optionsplay.com and I'll take a look at your account as to why you don't see that. What is a 50 delta call or a put? So why I do recommend that you take a look at some of our basic educational webinars, but delta is basically an approximation of the probability of a strike price being in the money at expiration. So a 50 delta call or a put is generally speaking what we refer to as the at the money strikes. So we usually sell the first strike outside of the at the money strike prices on these credit spreads. Are you working also with the debit spread list? Yes, we are also working with the debit spread list, and that is something we will be publishing here in the next, in November. Has there been a comparison of probabilities before expiration versus after expiration to see how close probabilities actually were? Patrick, yeah. So deltas, we've backtested this for many, many years, all the way back to about 2007 before the financial crisis. It is crazy how accurate delta is to actual probabilities of expiring in the money at expiration. So yes, a lot of people have been put to, I can't explain to you the countless computing cycles that options traders have put onto this task of calculating their probability models and whether they are accurate or not, because that is effectively the intellectual property of all market makers and options traders, is how good their volatility models are and how accurate they are at predicting probabilities. Recommended expiry is the same for all trades. Do you recommend expiry dates to be out if we are trying multiple trades from the list? No. So we always use 45 days to expiration. That is your optimal expiration date for selling a credit spread. We sometimes may vary by week. So sometimes some symbols we might sell the weekly option, other ones we might sell the monthly options, but generally you're not deviating no more than about 7 days or so. When would you consider different expiration dates in the two options of the credit or debit? Not sure what you mean by that, Barry, but the credit spreads we usually sell about 45 days out. Debit spreads, we'd like to go a little closer to 60 days. We're actually making some of our modifications to our application to account for that, where debit spreads are naturally selecting strike prices a little bit further away than credit spreads. So there's a lot of things that are coming up in the OptionsPlay platform to switch between debit versus credit spreads and automatically showing credit spreads in the OptionsPlay platform. And yes, there are plans to include the ability to create your own portfolio, rather pull in your portfolio from your brokerage firms, and also some paper trading possibilities. A lot of questions about paper trading, so we're exploring the ability to paper trade using OptionsPlay. Can one see these slides? Yes, all of them are available on our YouTube channel. If you look at any video on YouTube, there's a link at the bottom in the description with the link to the slides if you want to download them. Can you repeat what Tom does and what you do with the delta? So I sell the 50 and buy back to 20. Tom sells the 35 and buys back the 20. So his delta ranges are a little smaller. His net exposure is only 15 delta, so he has less delta exposure than ours. So his usually has less income with more risk, but it comes with a higher probability of profit. So many of his probability of profits are closer to 80% winners, but they're many times risking about 2.5 to 1 on the trade rather than 2 to 1. Is the max risk really just the spread of the strikes minus the premium collected? Is the max risk? Yes, that is. The max risk is just the difference between the two strikes minus the premium that you collected. Can you ever lose more than this amount? No, you cannot lose more than this account unless you get early assigned and you don't manage them correctly. And unless you hold them to expiration, get assigned on one leg, and then let's say the market moves over the weekend and you have a substantially large exposure where the long leg is no longer providing that protection. But again, if you keep to the rules by closing out your trades at those rules that we're referring to here, then you will never lose more than the max loss of that trade. Let's see. Do you have a gamma scalping strategy? Bill, we do not have a gamma scalping strategy. Do you calculate IV rank, i.e. 39% for Tesla versus implied volatility in Tesla, and Thinkorswim shows 80%. So IV rank is different than implied volatility. If you go to Thinkorswim and you scroll to the bottom of your options chain, there is a tab, there is a section on your options chain called option statistics. Under those option statistics, there's a indicator here called IV percentile. You'll see that IV rank for Tesla will probably be very close to 39% as well. IV rank only goes from 0 to 100. It's a different indicator than implied volatility. That's a completely different thing. IV rank is calculated from implied volatility, but implied volatility and IV rank are two different things. I thought IV rank varied depending on which option you choose. IV rank different than IV. That's correct. IV rank and IV are completely different. IV rank is a generalized volatility indicator versus IV is calculated for each individual strike price that you can trade. Please recommend a book for technical analysis. Joseph, I've been so far out of technical analysis in terms of books. I'd have to look that up. You can send me an email at info@optionsplay.com and I'll take a look. But I honestly, it's been probably a good 10 years before I've read a technical analysis book. I tend to find the Chart School on stockcharts.com is a really great online resource because technical analysis is much more interactive these days. You need a computer to do that technical analysis. So I find reading a book then going onto your computer is a little bit more difficult. If you go to Chart School at stockcharts.com. It's fully interactive and you can chart immediately on that platform. So I do recommend that. What time is the Friday webinar? The Friday webinar, the election special that we're doing tomorrow is at 9 a.m. You have to be a member in order to sign up, but it is at 9 a.m. Is there a spread bid ask that you would not enter because it's too wide? So Ted, what we've done with these credit spread reports is we only look at very liquid names. So I don't have to worry about how wide bid ask spreads, liquidity, open interest, volume. I don't have to worry about any of that. These are all names that have already passed bid ask spread filters. I'm sorry, liquidity filters. Isn't picking 5 to 10% out of the money short strike instead of at the money a safer play? It forgives you even if you have the direction wrong a little bit. So this is a great question. The question was, why not just choose something really far out of the money? And this is what I see a lot of beginners do. They'll sell something really far out of the money, and they do it because they think that, okay, I have a lot more room to, even if I'm wrong, I can still make money even if Tesla goes down to 385. Yes, that is true. But what you're doing is you're taking on a lot more risk for the amount of reward that you're doing. Like I said, all things are trade-offs, right? What you're trading off now is a higher probability of profit for a substantially worse risk to reward. If that's what you want to do, by all means, just understand that when you do lose, you're going to lose substantially more. I want to make sure that no matter what happens, even if the trade completely blows out and the stock goes really far in the opposite direction that I'm expecting to, that I do not take on a substantial amount of risk. When you do these high probability trades that you're talking about, you absolutely can do that. There's nothing wrong with it. Just understand what you're trading off when you're doing that. And unfortunately, most of the people that lost most of their money during this sell-off were doing those types of strategies. So when QQQ was trading at 300, we were seeing a lot of people selling these 1 week 290, 280, even 270 options that just got blown out from one quick move to the downside. And from my perspective, this was a sharp move, but it was nothing compared to what we saw during the coronavirus, right? You know, if you had sold some of these strategies, I saw some credit spreads where people were collecting a few $100s in income and taking on about $4,500 worth of risk because they were selling these really far out of the money credit spreads. And they thought to themselves, well, I have 98% probability of profit, 99% probability of profit. I'm good. I'm going to make money 99% of the time, forgetting the fact that the 1% of the time that they lose money, they wipe out potentially months, if not years worth of gains from that one bad month. And all you need is one bad month, one big black swan, and it takes you out completely. That's why I don't like doing that, because in my trades, even if you have a month where the stock market is down 40%, the most I'm losing is roughly 1.5 to 2 times the income that I'm collecting. That's the reason why I choose to have these relatively lower probability, but much lower risk trades. So don't just pick trades because you have a higher probability of profit. That is the one mistake that I see most beginners make, is that they choose probability of profit over everything else to their detriment in the long run. It works for you in the short run. It's better for you in the short run, but in the long run, it blows up in your face. This is what traders call picking up pennies in front of a freight train. Because that's literally what you're doing. You think that you're winning all the time. You're picking up small profits every single week, week to week, and you're thinking to yourself, this is a great way to make income. And all it takes is one bad week, and you've wiped out months, if not years worth of gains. Do you have strangle videos on YouTube? So I currently don't have a strangles video. We don't sell a lot of strangles here, but I certainly can create one. This is something that has been brought up a couple of times here over the past month, so I will consider adding that here in November. Profit loss. So I'm not sure, Joseph, what you mean by profit and loss, if you don't mind clarifying. I understand profit and loss. I just don't know what your question with profit and loss is. Is it better to use strike prices on $5 increments, as these tend to be more liquid? So Michael, yes and no. So I really like the weeklies because they provide a lot of flexibility in being able to pick strike prices that I specifically want. I can get much more granular. I can find that 50 delta. I can find that 25 delta. When they're $5 strikes, you tend to find it's a little harder to find exactly the strike you're looking for. However, liquidity is a factor of the stock. not which expiration date you're using. So it's not like the monthly options are more liquid than the weekly options. That's a common misconception. A lot of users, what they'll see is that weekly options have low open interest and volume. That's because they were just listed a few weeks ago, or maybe just a few days ago. That's why there's low open interest and volume, but they're not any less liquid. You can trade them just as easily as you can the monthly options. So don't be afraid to trade those weekly options that have no open interest and volume. Put your orders in at the mid price. You'll see that you'll likely get filled, especially in the names that are in the very liquid names on our list. Sorry to ask again, is there a P&L on the spreadsheet, trades that you've taken using the spreadsheet? Is there profit? Clifford, so yeah, we've, in our daily play performance spreadsheet, all the P&Ls are on there, all the closing trades. You can see when we entered, when we exited, what the profit and loss is on each trade. Why is there no credit spread report on the Canadian version? Michael, that's something that we're working on, but the Canadian version is different. It's a free version. The US is a paid version. That's why we spend a lot more efforts here, in my opinion, on the US version, but we are continuing to expand on the Canadian. We're looking to build Ivy rank for Canadian. We're working on new reports, including that credit spread report. That is something that we are working on here for the Canadian markets. Do you offer free trials? Yes, you can sign up for a free trial at OptionsPlay.com. We have a free 30-day trial. You can go to OptionsPlay.com to sign up for it. I'll post a link into the chat window. Just posted that into the chat window. Okay, I have 2 minutes for a couple of more questions. Please paste the YouTube links. So you can find our YouTube channel at youtube.com/optionsplay. I'll post that link into the chat window as well. Is it possible to enter your own stock into credit spread data spreadsheet? No. But there's really no need to, because that's what the OptionsPlay tool is for. You can enter into OptionsPlay and look at it there. Once in a trade, how do you use your portfolio function? So that's something that we don't have access to everyone just yet. That's only available to us to enter those trades into the portfolio tool. But we are currently looking at building out that portfolio tool for you guys to be able to enter your own trades. Does 21 days to expiration apply to cover calls? Generally speaking, Carlos, yes, it does as well. I have to slide the window up above my taskbar to see the black bottom. Oh, okay. Bill, you might have to, oh, okay, I see, look at that to respond to someone else. Is it possible to include the cover calls and short put reports on the OptionsPlay website? Martin, that is something that we are in the process of doing. So we have embedded the cover call and cash secured put reports into a website. We're actually hoping to release that website maybe in the next week or two. So very, very soon, you'll be able to see that within the website. Okay, I think I'm unfortunately running out of time here. I have to run, but I really tried to get through as many questions as possible. I know many of you still have questions to the OptionsPlay tool. So please, you can always submit questions to us using this question, ask us thing here at the upper right-hand corner for any questions you have regarding your trading strategies, and we'll answer your questions typically within a couple of hours. With that, thank you so much for taking the time out here this afternoon. I really hope that this was helpful in giving you a better understanding of how to utilize credit spreads for your portfolio and how to find those optimal credit spreads where the risk to reward is skewed in your favor. So with that, thank you so much. Have a great evening, and we'll send out the recording with the slides to you in about an hour or two once we finish processing the recordings. Have a great night, and I'll see you guys tomorrow morning bright and early for our election special for our members. Have a great night.